Welcome back to the channel, everyone. Today I want to talk about another senator being paid off and raising a proposal to not ban payment for order flow. I also want to talk about why it was already going to be tough for Gary Gensler to ban payment for order flow even before the proposal. So stay tuned and let's make some money. So Senator Pat Toomey's proposal is a blocking of the payment for order flow ban. The bill would prevent the SEC from banning on payment for order flow because it's a key revenue source for Robinhood and other brokerage firms. But don't forget, this is just a proposal, so it still needs to be voted on and the comments heard. Therefore, it's obviously not a guarantee, and I do still think and hope that payment for order flow will be banned. So Toomey defended the practice for helping develop new investment apps, low-cost trading, and more efficient execution. But we also know that low-cost trading can be given without payment for order flow because there's many brokers in the UK and elsewhere in Europe that do exactly that. And we also know that payment for order flow doesn't encourage efficient execution. In fact, it encourages quite the opposite because there's a conflict of interest. So Senator Pat Toomey will on Thursday introduce legislation to protect a controversial practice known as payment for order flow, the main source of revenues for online brokerages like Robinhood. SEC Chairman Gary Gensler, Wall Street's top regulator and a critic of the practice, has made reforming payment for order flow a top priority after the trading frenzy in stocks such as GameStop earlier this year. Specifically, Toomey's bill would prevent the SEC from issuing an outright ban on payment for order flow. And he said new innovations such as zero commission trading and user-friendly mobile apps have allowed more Americans to participate in the stock market than ever before. I do agree that user-friendly apps has made it easier to invest in the stock market. You don't have to go down to your local stockbroker to purchase some stocks anymore. You don't have to give them a call on the mobile phone and wait half an hour while you go through personal details to buy some stocks. But a user-friendly platform and payment for order flow aren't mutually exclusive. You don't have to use payment for order flow to have a trading app. Again, there's many in the UK and in Europe that work absolutely fine without payment for order flow. Also, Moomoo are currently running a massive new promotion. There's 3 free stocks. One stock valued up to $350, one with a guaranteed value of at least $54, and a third free stock, Neo, with a guaranteed value of $40 on top of all of that, just for signing up and depositing at least $100. With Moomoo, you also get free real-time level 2 market data to be able to execute the best trades. You also get advanced charting tools, and most importantly for me, you also get 24/7 real-time financial news so that you don't miss any key headlines or key news announcements. And he also said those zero commission stock trades help Robinhood persuade millions of younger customers to invest for the first time, and are credited for broader market participation across the US. But I think it's also important to remember that 87% of stocks are held and traded by the wealthiest 10% of Americans. And therefore, the majority of trading volume that goes on exchanges is performed, and most definitely can be performed, by people that probably wouldn't mind paying a $5 commission per trade or paying a $10 a month monthly fee. For people that can't afford a $10 a month monthly fee or a $5 commission per trade, probably aren't contributing too much to the total volume on the exchanges. It says though the payment for order flow practice has outsized implications for Robinhood. In a government filing published in July, Robinhood said 81% of its first quarter revenues came from payment for order flow. Now this is where the massive conflict of interest comes from. Robinhood obviously derive 81% of their revenues from payment for order flow, and therefore they're going to do anything they can to get the most amount of money, and they aren't going to want to sacrifice that money that they make because it's basically all of their revenue. Let's compare this in a weird way to the accounting world. An accounting firm can't accept a job that would be over 5% of their annual revenue because it creates a conflict of interest, and it's unethical because you basically do anything you can to get that 5% revenues or even more. Basically, as an accountant, we can't be biased if it represents 5% or more of our annual revenue, and therefore we're simply not allowed to take those kind of jobs on. Interestingly, it does say that the SEC have reviewed the practice several times before and has thus far agreed with brokers and traders that it benefits small investors, a principal concern for SEC Chief Gensler. Now, I think it also helps that there's a lot more awareness of what actually goes on in the market nowadays as well. Maybe last year we would have said that Robinhood is absolutely great because cheap investing or free investing is good. but it's because we were unaware of what truly goes on with payment for order flow and how it creates this massive conflict of interest. I think last year, if we knew that Robinhood was selling their order flow to Citadel so they could route it through the dark pool or off-exchange venues, I don't really think we'd be all too happy about payment for order flow like we are now. And as Gary touches on, he says still, nearly half of the volume transacted is executed in dark pools or by wholesalers, he added. I believe it's appropriate to look at ways to freshen up the SEC's rules to ensure that our equity markets reflect our mission and are as efficient and competitive as they could be. And fortunately, it does also say here, outside the SEC's analysis, the odds Toomey's bill becomes law anytime soon appear slim in a Congress controlled by the Democrats. Gensler, nominated to lead the SEC by President Joe Biden, has been encouraged by progressive lawmakers to step up regulatory oversight. And therefore, in a Democrat-controlled Congress, it's very unlikely that Toomey's bill could pass because they are trying to increase regulatory oversight. Furthermore, with Democrats intent on enacting trillions in spending, facing a looming debt ceiling and poised to review a slate of new Federal Reserve nominees, it's unclear whether the Senate could consider the legislation before year's end. Because obviously the Senate is so busy at the moment and has many more important fish to fry, such as the looming debt crisis, before they start looking at payment for order flow. Now obviously Senator Pat Toomey has been paid off. For only $1.2 million, you too can buy a congressman to work against the common man. The records don't lie, Toomey. You're a traitor to the American people. Toomey's campaign contributors are listed below in this link here. The second largest personal contributor being the DTCC. Number 5, 8, 16 and 20 are also very interesting and merit further investigation. Toomey's received $1.2 million in above board donations between securities and investment groups, retirement funds, large banks and more. Now obviously this isn't quite speaking fees paid directly to somebody like Janet Yellen. This is just fees that have been donated to his political campaign to help fund his campaign and his race. I personally think it's also a massive conflict of interest how much money these senators and congressmen do accept from large institutions and large banks. Whether they accept these fees to fund their political campaigns or whether they accept these fees as speaking fees, either way it's a massive, massive conflict of interest. It effectively just encourages them and just truly pays them off to say whatever they want to say as long as it's positive and a good outcome for those big banks and institutions that paid them all the money. I personally think there should be a ruling on how much money senators and congressmen can accept from institutions like banks or just from anyone when funding their political campaigns or accepting in speaking fees. Because at the end of the day, if you're attending a conference, it's fine for somebody to pay your petrol costs, maybe pay your hotel costs, maybe give you a bit of money for it to be financially worth it for you. But I think $800,000 for a quick 2-minute speech is just unnecessary. And now I also want to talk about why it could be tough for the SEC to ban payment for order flow. Gary said, I've really said to staff, look, payment for order flow and what we do with that, whatever restrictions, is on the table. But we're also looking at things that are within the market structure itself as well. But University of Notre Dame Associate Law School Professor Patrick Corrigan told Yahoo Finance that at a minimum, regulators do have the tools to limit payment for order flow. Those regulators do include the SEC and FINRA, or the Financial Industry Regulatory Authority. However, he described the question of whether the SEC can outright ban the practice altogether as a legal grey area. He said the authority here is not clear-cut. He said there's a reason why the SEC has not banned payment for order flow in the many decades the practice has existed. The anti-fraud and disclosure statutes that form the basis of the SEC's authority don't support it. Prohibiting a fully informed customer who is assured of best execution from electing to execute free trades through a broker who receives payment for order flow would also go against the surge in democratizing access to securities markets. I guess the key points here that Gary Gensler is focusing on is both prohibiting a fully informed customer, whether Robinhood customers are fully informed or whether they've been gamified, and also who is assured of best execution. While they are assured of best execution, they're definitely not receiving best execution. Because obviously there's a massive difference between just assuring somebody that they're getting something and actually giving it to them. He said one specific regulation the SEC could use to at least argue for a ban is regulation best interest. Under the rule, broker-dealers like Robinhood and those with similar services have a duty to provide the best trade execution for their orders. There is a question as to whether this payment for order flow practice creates conflicts of interest in meeting the duty of best execution, but he also says that that argument isn't perfectly fit for supporting a ban because it applies only when broker-dealers are providing personalised investment advice about securities to retail customers. And because Robinhood aren't necessarily advising you to buy specific securities, he thinks that they don't necessarily fall into this rule. Critically, the SEC couldn't just ban payment for order flow outright under that authority, unless perhaps it could characterise the platforms as those making investment recommendations. Potentially, you could argue that Robinhood did make a recommendation because they did encourage customers to invest in their Robinhood IPO. But I think it could be quite hard to apply that regulation to other trading platforms out there, like TD Ameritrade, for example. The article goes on to explain some other difficulties and some other avenues that the SEC could try, but it basically explains that it's not quite as clear-cut as Gary Gensler just turning around and saying payment for order flow, it's banned. Now, I also wanted to show you this interview. I didn't really want to play the full interview because it's about 6 minutes long, but basically the interviewer talks about China planting 85,000 bombs to destroy all of these unfinished properties. I find this really interesting for a few reasons. I think if the properties were going to be finished, and if these property developers weren't in any real serious trouble, they would have left the buildings where they were and not destroyed them. But I think because these property developers are in serious trouble and they know these properties aren't going to be finished for 5, 10, 15, 20 years, they basically decided it was easier and cheaper just to destroy all of them. Now, you may also see that headline down the bottom saying, "Is China covering up a financial crisis?" I think this is a really interesting point to consider. Why would they be trying to cover it up though? And it's because Evergrande actually owes money to 171 different financial institutions in China alone, and owes money to another 121 financial institutions elsewhere around the world, like in the US. So clearly they are in a lot of trouble, owing a lot more money than China is currently letting on. The interview also then goes on to talk about China potentially covering up the financial crisis and how they're doing it. How they're censoring customers, they're censoring investors, and they're even censoring employees from making statements on social media, similar to how they did with the pandemic. Guys, be sure to let me know down in the comments below what you think about another senator being paid off and trying to stop the SEC from banning payment for order flow. And as always, guys, if you enjoyed this video, be sure to check out some of my others. Alternatively, subscribe to the channel and ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.